With eager anticipation, earnings season truly begins in earnest with this release. The most profitable business in the world, a cash flow machine, a driving force for technological progress, a divisive, magnificent seven business. Divisive because Wall Street's old guard pushes one narrative and retail investors push another. A dying business that's growing over 10% per year. Google, the king of search, has released their earnings. But is their formidable reign coming to an end? Welcome to the Quality Investor. Wall Street is notoriously short-sighted. This has always been a gripe for long-term minded retail investors. Yet, after certain earnings reports, I'm left shaking my head in astonishment at just how short-sighted they really are. And with the latest earnings from tech titan Google, it is bewildering. How can a group of admittedly very smart people run the same narrative over and over? Once new information becomes available, how can one not incorporate that into their opinions? And why does the street view CapEx so negatively? The answers to these questions will always remain. Today, though, as much as I want to rake Wall Street, we are discussing yet another outstanding quarter from Google. So buckle up, because there is a lot of good stuff in their latest earnings extravaganza. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. There are three main concerns for investors. How is their core business search performing? Is cloud growth accelerating or decelerating? And how is AI ramping up? Search has been Google's core for over 2 decades now. This is the business that is supposedly dying because of ChatGPT, Perplexity, and other AI LLMs. But we just saw 12% year-over-year growth, which accelerated from Q1's 10% growth. Dying businesses are not accelerating. Google is. For me, this ties in directly with Google's AI question. Their biggest response to ChatGPT has been integrating AI overviews with their traditional search. CEO Sundar Pichai says overall queries on search continue to grow year over year, and that AI overviews powered by Gemini 2.5 are driving 10% more queries globally. My view on this is that Google is finally leveraging their search engine and all of the proprietary data from it and integrating it with AI. This is what gives them an edge. It is similar to Netflix and streaming. Netflix was first in streaming, and once they started producing their own content, that's when their operating leverage really gained momentum. All other traditional media platforms are now playing catch up. Google has been so dominant in search for so long. Once their AI proved as capable or better, depending on who you ask, than other AI models, integrating that into their core business would simply drive more growth and force the others to play catch up. I think we're starting to see that. We'll get into more numbers on search in a bit. Google Cloud is fast becoming an important component of Alphabet's overall business model. Now at 14.5% of Google's total revenue, double from 4 years ago, it is also scaling incredibly fast. Cloud is leveraging AI, but in different ways. It has an annual run rate of $50 billion, and demand for it is increasing. Cloud is where much of the infrastructure for AI is being built out with their data centers and cloud regions. It hosts data platforms for countless businesses, and I can tell you from firsthand experience that Google Cloud Platform generates interesting insights with its AI data analytics. The increasing demand for cloud is causing supply constraints in the form of compute and is the impetus for Google raising their 2025 CapEx guidance by $10 billion to a staggering $85 billion. They expect to spend even more in 2026 on CapEx. This signals massive demand and huge opportunity for Google long term. Sundar Pichai certainly seems optimistic about the ROI on that spend on the earnings call. So let's get into the earnings report itself and actually look at the growth this quarter. We'll also look at YouTube, an area I haven't touched on yet, and also assess usage rates across Google's various platforms and apps, and what that may portend going forward. And as always, we'll assess what their current buy price may be, and if loading up now might be a tantalizing prospect. Right now, Google is at $192.80. Given how strong the earnings report was, I believe investors, especially retail investors, were expecting a little bit more of an increase or a bump in the share price, and we really haven't seen that. You can see post earnings here that it dipped a little bit, but then it climbed back up and in a sense sort of just traded flat. I think people were expecting it to go to at least 200. You're going to get a lot of different explanations as to why we haven't seen more of a bump from Google. My belief is that the CapEx spooked the market a little bit. And like I said in previous videos, for some reason, Wall Street really doesn't like elevated CapEx spending in the short term. Despite that though, Google has seen a nice rebound in their share price since the April lows and all the tariff debacles, steadily increasing since that time to where we're at today. And with the little bump that we did get, Google is now actually positive year to date. Year over year, we continue to see just incredibly strong growth out of Google. Revenues in total up 14% year over year, costs of revenue up 10%, so the gross margin saw some expansion here. However, the operating margin did remain flat year over year, but overall just more strong growth out of Google. Net income up 19% and earnings per share up 22% year over year. Looking at segment growth, however, this is where we're seeing some very strong growth for Google that the market was not expecting. We have 12% year over year growth for Google Search. Again, this is the business that is supposedly getting disrupted by AI, yet they're still growing at least 10% per year. And if we look at this tweet here from Brad Freeman, it says, common argument, Google search is dying. My data-driven counter argument, no it isn't. Strong 2.5% beat versus consensus, accelerating growth. What does he mean by that? You can see in Q1 2025 to Q2 of 2025, we went from 9.8% growth in year-over-year search to 11.7%. So sequentially, we're seeing accelerating growth here. However, we can also see from Q1 of 2024 until about Q1 of 2025, we did see a deceleration in growth. And I believe this is really what has been keeping Google either trending down or flat over the last year or so. This is where I believe a lot of investors, especially on Wall Street, thought that search was being disrupted by AI. But even while growth decelerated in Q1 of 2025 to 9.8%, we saw strong total numbers in search. You can watch the video I did on the Q1 Google numbers. And then we're seeing not only strong total search volume, but also accelerating growth in their revenue. I told you we would also mention YouTube here when we look at the numbers, and you can see more very solid growth here. 13% year over year for YouTube growth. Again, this is acceleration. 10% in Q1 to now 13% here in Q2. And even the subscriptions, platforms, and devices segment is accelerating growth. They had 18.7% in Q1, and we see 20% growth year over year here in Q2. Operating margins did remain flat for the Google Services segment, but the top line growth that we're seeing is very encouraging going forward for Google. But like I've mentioned in many of my Google videos, the real star here is Google Cloud. And you can see that that growth is truly exploding. Year over year, Google Cloud saw 32% growth. It's been accelerating now for a couple quarters, 28% growth sequentially from last quarter. The operating margin expanding massively. This indicates how well Google Cloud is scaling and how they're really achieving very solid operating leverage here. Looking at the quarterly growth on a year-over-year basis here, from about September of 2023 quarter onwards, it's been a solid trend upwards of accelerating growth. Yeah, they had a little bit of a blip here, but we're now back into solid acceleration territory. And on the earnings call, one of the major themes was the huge demand that we're seeing for Google Cloud and the necessity for Google to continue to really pour money into their data centers in order to meet that demand. The demand is only increasing. we should expect to see more acceleration out of Google Cloud, and that's something we should keep paying attention to over the next few quarters. A few more things I want to point out here. The Gemini app, now at 450 million monthly active users, up from 400 million. I saw in another tweet, I linked it below, that ChatGPT is about 500 million monthly active users. So the competitor app from Google is catching up there. And you can see too, also noted in this tweet, that search, which is the most important metric, had the most bearish narrative associated with it, grew 11.7% versus the 8% expected. Google is absolutely executing right now, and the market still has not caught up to this. With this tweet from one of the ultimate Google bears, Gene Munster, the Google call has wrapped up. Message from management: search is rock solid and AI is working with new revenue opportunities down the road. My take: I've been negative on Google over the past 6 months because of the long-term AI shift, which we're still not seeing, by the way. That risk is still on the table, which is true, but search was so strong that investors will likely come back to the stock over the next few months. I can't imagine that this tweet was very pleasant to type out for one of the ultimate Google bears, but this just shows how strong of a quarter they had, that even the bears had to admit strength here. Looking at Google over the last 10 years, you can just see the incredible growth of this business. The trailing 12 months now, we have $371.4 billion in revenue. You can see from a 3-year basis on revenue growth to a 1-year basis acceleration here, and now we're again accelerating on revenue for the trailing 12. Even free cash flow has grown almost 5% on a 1-year basis versus a 3-year basis, given how much CapEx spending Google is really doing. And you can see that massive CapEx 1-year increase here at 62.9%, but just very rock solid fundamentals for Google as a whole. But even more importantly, they're growing their margins. Gross margin on a trailing 12 basis now at 58.94%. I mentioned how that was growing year over year. Operating margin 32.7%, relatively flat, slightly up on a trailing 12 basis. Free cash flow margin, now this is down, of course, because remember, they just massively increased their CapEx spending. But I want to point something out here. You can see that free cash flow margin in fiscal year 2018 was down to 16.7%. 2018 also kicked off an elevated CapEx spend for Google that lasted through about fiscal year 2020. But what we see here, that free cash flow margin expanded primarily because those investments started paying off. Investments made here, you see the return down the road. And you can see that in the ROIC down here as well. After Google made some big investments in 2018, ROIC remained flat a little bit before starting to spike up again in 2020. And we're seeing that decline here from fiscal year 2024 on a trailing 12 basis down a little bit here. Huge investment ramp up. What do you think this number is going to look like 5 years down the road? In my view, we're going to see another nice trend upwards here. So what kind of growth can we expect out of Google over the next 10 years? Despite the strength that we're seeing in search, I remain pretty conservative here in my estimates. On a bear case, I have it growing at 6% up to a 10.4% for the bull case. And even YouTube, I'm still pretty conservative. 7.6% on the bear up to 10.4% on the bull case. Google Cloud, however, is where I'm a little bit more aggressive. I have an 11.8% growth rate on the bear case over the next 10 years, up to 19.2% for the bull case. You can see in the last 5 years, Google Cloud has grown 37% annually. We should not expect to see that level of growth over the next 10 years, but if they continue to execute and the demand is there, like they're claiming, I would not be surprised to see 20% growth out of Google Cloud over the next 10 years. Ultimately, that gives us total revenue growth here on a bear case of 6.6% up to 11.3% for the bull case. In my view, these are very conservative and realistic estimations. The margin here is really driving this valuation. You can see on a trailing 12 basis, it's at 32.7%. Now, on the bull case, I have my margin by year 10 at 42.5%. Remember, I showed you what the margin growth for Google Cloud was. It nearly doubled year over year to 20-point-something%. This is what's going to drive margin expansion for Google. Google Cloud, as they continue to scale, their operating leverage is only going to go up here, and it really will drive their margins. Their free cash flow margin, while on a trailing 12 basis, is at 18%, lower than the historical norm for Google, but that should grow quickly once they reduce their CapEx spend a little bit heading into 2027. And on a bear case, I have the free cash flow margin at 26.7% up to 32.8% for the bull case. The PEG ratio also looks very good. It's not great, but a 1.65 PEG ratio for Google in my view, is very good. And as we'll see here, this investment does look attractive. As of this recording, Google is at $193.09. Not a lot of movement today in their share price, not even 1% growth on the day. Again, a little bit disappointing for retail investors given the earnings report. Their PE ratios at 20.6, still far below their 5 and 10-year average. Their 21.3 forward PE is between their 5 and 10-year average. And right now the market, given a $193 share price, is pricing in free cash flow growth over the next 10 years of 8.4%. I'm pricing in about 12.9%. And I think I'm being conservative, to be honest. The DCF, the bear case here, is at $203.43, $268.09 for the base case, and $354.26 for the bull case. Google just started paying a dividend. It remains to be seen how fast or how well that dividend will grow. But right now in a bear case, I have it $117.15, $171.68 on the base case, and $266.92 for the bull case. The exit multiple I have at $312.50. My comps are Meta, Microsoft, Netflix, Apple, and Amazon.com. So even on the bear case, we have some pretty decent, not great by any means, upside at 8.3%. But on the bull case, if they execute, if this CapEx spend pays off, we should see huge upside for Google, 66.75%. Without any margin of safety, that's a buy price of $260.32, a forward PE of 28.7. With a 20% margin of safety, I have a buy price of $208.26 with a forward PE of 22.9. Google is starting to really prove its strength here. Maybe some people might be comfortable with a 10% margin of safety. I'm not quite there yet, but I think anything under $210 right now for Google is still a buy. I raised that up from $200 last quarter. This quarter just showed the strength of their search. I think that's what a lot of investors were looking for. They hit it. If we continue to see that strength, this stock might be unstoppable. The narrative will shift on Google. It's just a matter of time. I think a 23 PE, and I believe a 23 PE is a very reasonable valuation for this business. A 23 forward PE still would be between their 5 and 10-year average. And remember, none of this discusses what they're doing in Waymo right now. I still think we're gonna have to wait a few more quarters to see how profitable that business can be potentially. At this point, Google's two biggest drivers in my view are gonna be Google Cloud and YouTube. And as long as search just steadily grows, even if it's not growing at 10%, if it grows between 8 to 10%, this business will continue to print cash for investors.
Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.